Welcome to today's FATF webinar on promoting financial inclusion through risk-based approach to AML CFT. My name is Takahide Habuchi, co-chair of the Policy Development Group at FATF, and I will be moderating today's webinar. Bringing more people into the formal financial sector is crucial to our fight against financial crime and has been a priority for FATF. With approximately 1.3 billion people around the world still without a bank account, earlier this year, FATF adopted revision to its standard and methodology to better promote financial inclusion through increased focus on proportionality and simplified measures under the risk-based approach. To support countries and private sector in implementing the revised standards, FATF published an updated guidance on financial inclusion and AML CFT measures in June this year. Today's webinar aims at presenting and explaining the key changes to the updated standards, methodology, and guidance adopted by FATF earlier this year, as well as discussing practical scenarios to implement AML CFT measures compatible with promoting financial inclusion. Through this webinar, we would also explore the main challenges faced by supervisors and by regulated entities in implementing risk-based approach. Before we introduce our distinguished speakers today, I'd like to introduce some housekeeping rules for today's webinar. As you may have noticed, this is an open webinar with a broad audience from the global network, including public officials, private sector, industry organization, academia, think tanks, and any other stakeholders interested in this topic. The webinar will be recorded and posted on the FATF social platforms later. In addition, given the relevance of the topic, the FATF Secretariat has provided French simultaneous interpretation for this webinar. So participants are asked to select the channels of English or French according to their need in the bottom of the screen. Interaction with participants took place ahead of the webinar. We have received hundreds of responses to the survey on AML CFT measures and financial inclusion, and over 1,000 questions. Our speakers today will comment and respond to those questions to the extent possible. Now, let me introduce our distinguished expert from diverse background today. First, Catherine Dion. She is, after more than 20 years in the financial sector, Catherine joined the Ministry of Justice in Luxembourg in 2023 as National Coordinator for the fight against money laundering and terrorist financing, and she is head of FATF delegation for Luxembourg. Catherine is also the project co-lead for FATF's recent standards revision and guidance update on financial inclusion. Our second speaker is Robin Newnham. Robin is the head of policy analysis at the Alliance for Financial Inclusion, a global community of financial regulators working to advance safe, sound, and inclusive financial systems. Our third speaker is Flora Hernandez. Flora is the General Director at National Banking and Securities Commission, or CNBB, Mexico. As an experienced player in financial sector, Flora is currently specialized in AML CFT supervision for fintech sector and has previously performed as a legal director for a development bank specialized in agricultural and livestock issues in Mexico. And our fourth speaker is Helen Elftemeyer. Helen is the sector coordinator for AML CFT and sanctions at Dutch Banking Association. In her current role, she drives and manages banking and public-private initiatives to improve outcomes and efficiency in the fight against financial crime. Prior to joining Dutch Banking Association, she worked as KYC lead at ING and ABN AMRO. After multiple responsibilities in financial markets, asset management, and private and corporate banking, she is working on and passionate about transforming the AML safety ecosystem toward a more effective and proportionate control framework. So it is our great honor and pleasure to have those four very fantastic speakers today. Now, first, I'd like to ask Catherine for introduction of FATF's recent revision to standard methodology and also policy intents behind such revisions. Catherine, the floor is yours.
Thank you. Thank you very much, Takahide. And good morning or good afternoon, everyone. I am delighted to take part in this presentation. I will structure my presentation in three parts. First, the changes to the standards, then changes to the methodology, and finally, a few words on the guidance. First of all, a few introductory words. Why financial inclusion is important for FATF. So financial inclusion has always been important for the FATF, but what are we really talking about? I would like first to give a definition of financial inclusion. It is the availability and equality of opportunities to access financial service for everybody, individuals and businesses. Inclusiveness is important because without access to the formal financial system, unserved or underserved persons will resort to cash or unregulated channels, which limits transparency and, moreover, it increases the risk of crime and money laundering. The FATF recognizes that applying an overly cautious approach to AML-CFT can have the unintended consequence of excluding legitimate businesses and consumers from the formal financial system. Also, AML-CFT policies have long been criticized for cutting off vulnerable communities from formal banking system. But now FATF acknowledges that financial exclusion is itself a risk. Under the Mexican presidency, financial inclusion is a priority. In that sense, financial inclusion and AML-CFT measures are considered as mutually supportive and complementary policy objectives. This is why in October 2023, the FATF launched a project to develop targeted standard revisions and to update the financial inclusion guidance in order to encourage genuine consideration of simplified measures and also discourage over-compliance with AML-CFT measures, which often leads to de-risking. This to better support financial inclusion. In February 2025, the FATF plenary adopted the standard revision with the following objectives. First, an increased focus on proportionality and simplified measures in the risk-based approach, and greater confidence and assurance when implementing simplified measures. Then, when the plenary agreed to open a public consultation, the responses from the public and private sector and civil society were very supportive and greatly welcomed the revisions. So next slide. Yes, thank you. The revision of standard focuses on recommendation 1, And some related amendments were also made to the interpretative notes to recommendation 1, 10, and 15. In the first place, the first main objective is to promote higher focus on proportionality. Until then, countries had to apply AML CFT measures commensurate with the risk identified. The plenary decided to replace the word commensurate with proportionate throughout the standards, so as to harmonize language in the recommendations and to align FATF language with that of financial inclusion stakeholders and frameworks, and also to promote higher focus on the proportionality objectives of the risk-based approach. In order to make things clearer, a definition is added of what is proportionate. It points out that the proportionate or commensurate measure is one that appropriately corresponds to the level of risk and effectively mitigates the risks. Moreover, you will see that the guidance specifies that where there are two or more measures that would both effectively mitigate MLTF risks, the least burdensome option, having regard to financial inclusion, would typically be the most appropriate option. Next slide, please. Now, considering the revision of interpretative notes to recommendation 1, the revision includes clarification for supervisors. First, supervisors should ensure that financial institutions and DNFBPs are proportionately implementing their obligations. And second, they should review risk mitigation measures they undertake. The objectives are to align the requirements on supervisor more closely with the focus on proportionality concept and the existing requirements, and to prevent overcompliance that may stem from an incomplete understanding of risks. So the role of supervisory authorities is to take into account the principle of proportionality and the risk mitigation measures put in place by financial institutions and DNFBPs in a risk-sensitive environment. At the end, regulated entities should feel more comfortable applying proportionate measures without fear of excessive scrutiny. Next slide, please. The second main objective is promoting the adoption of simplified measures where risks are lower. Some amendments were made. The wording of the interpretative note has been reviewed accordingly, replacing countries may decide to allow simplified measures with countries should allow and encourage simplified measures. The aim of this is to provide greater clarity and emphasis on countries' obligation to enable simplified measures in lower risk situations and to incentivize proactive steps towards implementing these measures. The encouragement can, for example, take the form of guidance or other form of engagement to improve understanding of the circumstances when simplified measures may be appropriate and what form they may take. This includes, but is broader than only simplified customer due diligence measures. For example, simplified nature and intensity of oversight by supervisors, and simplified registration and licensing requirements, for example. Next slide, please. Now, concerning the requirement on financial institutions and DNFBPs, in the revision of the interpretative note, the sentence, when assessing risk, financial institutions and DNFBPs may differentiate the extent of measures, is replaced with, when assessing risk, financial institutions and DNFBPs should consider differentiating the extent of measures depending on the type and level of risk. The aim is to place a requirement on regulated entities to be more active in tailoring their measures to the identified risk level. It emphasizes the need to actively assess risks and tailor measures accordingly. It is, in fact, a recognition of flexibility in the approach. Next slide. the textual amendments intend to provide further clarity and flexibility regarding the application of simplified measures and exemptions. The modification is as follows. Countries may decide to exempt certain requirements, provided there is an assessed low MLTF risks. The exemption occurs in limited and justified circumstances. So now it's only limited instead of strictly limited as before, and assessed low risk instead of proven low risk as it was before. The advantage of this redrafting is that it aligns better with the proportionality principles, and it ensures applicability of low risk exemptions is not unnecessarily restrictive. As for the second modification, concerning the lower risk areas identified by regulated entities, the word consistent with country assessment are replaced by with due regard to country assessment. This is to avoid the misconception that lower risk areas identified by regulated entities have to be the same as those identified by the country. This should not be automatically the case. Next slide, please. During the discussions, it became clear that the proposed amendments to recommendation 1 should be taken into account in other interpretative notes, in particular interpretative note 10 and 15. In the note 10, the revision concerned non-face-to-face business relationships and transactions. Until now, they were considered as an example of potentially higher risk situations. Now, they are potentially higher risk only where appropriate risk mitigation measures have not been implemented. The aim there is to recognize that non-face-to-face interactions have become standard business practice in many countries. That may help with financial inclusion, while also acknowledge that the risk still potentially exists. It was also important to align the wording with the FATF 2020 guidance on digital identity. Actually, this guidance specifies that when non-face-to-face customer identification and remote transactions are based on reliable and independent digital identification systems and are accompanied by appropriate risk mitigation measures, these relationships may present a standard level of risk or even lower risk. Next slide, please. Following the adoption of the amendments in the standard and the interpretative notes, it was then necessary to review the methodology for conducting mutual evaluation to ensure consistency. This was made in June 2025. So revisions were made to immediate outcome 1, 3, 4, and 11 to mirror the language of the revised recommendation was one as closely as possible. The changes are now applicable to all mutual evaluation with technical compliance questionnaire submitted after the adoption of revised methodology in June 2025. What will the assessor look at? They will see how countries and private sector identify lower risk areas. They will look at how public policies, and supervisor encourage simplified measures and provide guidance to private sector and consider exemptions. And they will look at how private sector differentiate measures, including simplified measures. Finally, if this does not happen, assessor may adopt recommended actions. Next slide, thank you. Actually, standard and methodology revision are indeed two fundamental milestones in the process, but the key lies in effective implementations. That's why we also updated the FATF guidance on AML CFT measures and financial inclusion. The objective of this new version of the guidance is obviously to reflect and clarify the standard revision, to update the concept and state of financial inclusion, and more practically, to provide additional guidance and example to support the effective implementation of the risk-based approach. As you know, the aim is to encourage countries to promote financial inclusion and to take proportionate and risk-based approach in implementation of AML CFT standards. It is non-binding and obviously does not override the purview of national authorities. In fact, it highlights the need to better inform the countries and regulated entities of the financial inclusion dimension of the AML CFT framework. Next slide. So to finish with, I will give some key messages. First, financial inclusion and AML CFT measures are mutually supportive and complementary policy objectives, considering the misapplication of FATF standards can contribute to financial exclusion. Second, the concept of financial inclusion has expanded from access to regulated financial services and products to also cover appropriate usage and quality. The third message is that applying a risk-based approach doesn't just mean enhanced measures when risks are higher. More emphasis should be given to adopting simplified measures in lower risk situations. Fourth and last consideration, over-compliance is not in line with FATF standards. In fact, bringing more people in the regulated financial sector is crucial to the fight against financial crime. I will stop there and give the floor back to Takahide. Sorry if I've been a bit too long.
Thank you, Catherine, for giving us a good overview of revised standard as well as FATF updated guidance. So as you showed clearly in your last slide, I'd like to reiterate that risk-based approach and proportionality are two of the key concepts in FATF standards, and over-compliance is not something FATF want for public sector and for private sector. And for if some of you have not gone through the FATF's updated guidance on financial inclusion, I'd really like to encourage you to go through that document because it's full of good advice for government and also for private sector on how we could successfully implement it, risk-based approach, especially how to apply simplified measure in the case of lower risk. So thank you, Catherine. Now, let's look at the implication of new FATF standards and how public and private sectors can implement them to achieve the intended outcome, which is both authorities and obliged entities need to look at both higher and lower risks and apply proportionate measures, including simplified measures where risk is lower. With this, we can spend time and resources to address higher risks and reduce burdens and cost where risk is lower. Now, I'd like to ask a question to Robin. From the perspective of central banks invested in financial inclusion, what are the challenges faced by your member countries in striking the right balance between advancing financial inclusion and ensuring AML CFT compliance? How do the recent standard revision by FATF help in addressing those challenges? Robin, over to you.
Thank you very much indeed, Takahide. It's a great pleasure to be here for today's webinar, representing the Alliance for Financial Inclusion. So as you can see on my first slide, AFI is a global network of financial regulators from more than 85 developing and emerging economies. And our members are central banks and financial authorities who are responsible for the safety and soundness of their financial systems. But they do also share an equal commitment to financial inclusion, not just as another policy goal, but also as a fundamental human right and as a catalyst for inclusive economic development as well. AFI therefore does work very closely with the international standard setting bodies, the SSBs, including the FATF, and that's really to make sure that global rules for financial integrity and stability are proportionate and inclusive as far as possible. Moving on to my next slide, I'll clarify some key terms. So firstly, financial inclusion in the AFI network is understood as not only as enabling access to a bank account, but also effective use of a range of affordable and appropriate financial products to improve their lives. And this more holistic definition of financial inclusion, as Catherine mentioned, has now also been incorporated in the FATF's recent guidance published in June. And that's important, I think, because it positions financial inclusion not only as an issue for certain countries, but actually as an issue for all countries, even advanced economies. Financial integrity, on the other hand, refers, of course, to the safeguarding of the financial system against misuse. And in the FATF context, there's particular emphasis here on combating money laundering, terrorist financing, and proliferation financing. And traditionally, these two goals of inclusion and integrity have been seen as separate policy silos. But to avoid this, in AFI, we use the concept of inclusive financial integrity. And this really means designing financial inclusion and AML CFT measures in a way that's well aligned and mutually supportive. And this vision is eminently achievable, but it won't happen automatically. It does require intentional design and coordination between and across policymakers and with the private sector as well to achieve outcomes that both protect the financial system, but also expand its reach to the underserved. On the next slide, we can see that the FATF, for its part and its great credit, has explicitly acknowledged the complementarity of financial integrity and financial inclusion through the risk-based approach. And that allows countries and financial institutions to apply simplified due diligence when risks are assessed to be lower, such as for small accounts or for low-value mobile wallets that are very important for advancing financial inclusion. However, what the FATF's own analysis of the unintended consequences of its standards found is that there has been a gap between theory and practice in this regard, with advanced economies actually making greater use of simplified due diligence than emerging economies and developing countries do. So in other words, the jurisdictions where financial exclusion is actually the highest have been making lesser use of the flexibilities in the risk-based approach thus far. And this has led to continued documentation barriers and exclusion in some jurisdictions of those customers who are actually lower risk, but they just lack the formal means of identification. And that can hit disproportionately disadvantaged segments, including women, youth, people with disabilities. So going on to the next slide, why did the risk-based approach not fully deliver for financial inclusion thus far? Well, essentially, I think we can see that the RBA was very useful in providing permissions. It allowed countries to implement simplified due diligence in lower risk scenarios, but this was permissive rather than mandatory. So each country and each financial institution could choose whether or not to make use of those permissions for simplified due diligence. What often occurred in practice is that without strong incentives or guidance, many jurisdictions, many financial institutions tended to default to more stringent approaches across the board. So perhaps the key lesson we can take is that just having the risk-based approach in the standards has not always been sufficient to change behavior without also addressing these other elements of incentives and capacity to confidently implement proportionate measures. And I think that's a nice segue to the 2025 changes that Catherine already outlined. So I won't go over all of them, but I'd just like to highlight some opportunities that we see coming out of these changes this year. So first of all, we do now have explicit language that countries should not only allow, but actively encourage simplified measures where risks are lower. And this is really important because it gives regulators and providers as well a clearer mandate to use tiered due diligence, to use simplified onboarding and exemptions in low risk scenarios without necessarily feeling like they're pushing the boundaries. There's clear FATF backing for those measures now. Secondly, the guidance elevates financial exclusion itself as a money laundering and terrorist financing risk. And this means exclusion should no longer be just treated as a separate social issue, but actually it should be analyzed in national risk assessments. And supervisors should also consider whether regulatory barriers are actually having unintended consequences of pushing customers into the informal system. Thirdly, the changes explicitly respond to the long-standing problem of overcompliance and de-risking. We have very clear language now that wholesale de-risking is inconsistent with the risk-based approach. And this can better enable supervisors to challenge zero-tolerance behaviors and to encourage proportionate evidence-based measures. Fourthly, the updated guidance, as Catherine mentioned, is encouraging digital solutions. It's recognizing that secure digital identity, digital onboarding is really the norm in a lot of places now across the financial sector. And that this doesn't necessarily entail a higher risk, provided that it's making use of robust national digital identity systems. So those are some key opportunities, but real impact is going to depend on what happens next in implementation. So a few suggestions for consideration here as well. First, I think it's clear that we need to follow the standards and guidance changes up with deeper downstream capacity building. The reforms need to translate into supervisory practice and also into industry practice. And that could entail clearer supervisory guidance as well as practical training for providers on operationalizing simplified measures. Secondly, the guidance focuses heavily on low-risk contexts and simplified measures, but there are also scenarios where inclusion is needed in non-lower risk scenarios. So, for example, refugees or migrants that are fleeing from conflict-affected jurisdictions, they might not fall neatly into the low-risk category. And in those cases, we'll need to have proportionate and tailored frameworks that really take account of the specific risks in those situations. And finally, the changes do give momentum, I think, to mainstream financial inclusion across FATF's work as a cross-cutting lens. So the challenge here will be to elevate financial inclusion not only as a discrete special project, but also as an ongoing and cross-cutting consideration to factor into relevant work streams going forwards. On my last slide now, Catherine already covered the financial inclusion guidance published in June, but I'd just like to highlight as well that it is rich with case studies from around the world, showing real examples of proportionate AML CFT measures that have advanced inclusive financial integrity. I've just put 3 on the slide, but there are many more. So in Egypt, for example, there was implementation of a simplified due diligence framework for low-risk accounts that help bring more women, youth, informal workers into the formal sector. In El Salvador, the central bank wrote the risk-based approach into laws and regulations, and that enabled a lot of product innovation around simplified savings accounts and use of digital channels as well. And finally, in Fiji, the authorities permitted alternative forms of ID verification, given there is not yet a comprehensive national ID. So this allowed, for example, community leaders to verify the identity of people in their communities. And that allowed expansion of the financial system without significantly elevating integrity risks. So these examples are just nicely illustrating the principle of proportionality in practice. So to conclude my presentation, I'd just like to recommend FATF for these reforms. I do think they take us a long way forwards in respect of the text of the standards, and they will significantly help to catalyze inclusive financial integrity. But of course, the real challenge is going to be in the effective implementation that lies ahead, and that's going to need collective effort of all actors in the AML CFT ecosystem. Thank you very much. I'll pass back to you, Takehide.
Thank you, Robin, for sharing with us on the concept of inclusive financial integrity and implication of standard revisions. And also, I'd like to echo in what you said, especially in terms of the need for capacity building, both for supervisors and for regulated entities, so that we could really achieve the objectives of this standard revision on the ground. And thank you very much for sharing a very interesting insight from your perspective. Thank you very much. Now, I'd like to come to Flora. I understand Mexico has done a lot to support financial inclusion. From a supervisor's angle, can you share with us Mexico's experience in regulatory reform and guidance to enable simplified measures and enabling tiered CDD approach? Flora, the floor is yours.
So good morning, afternoon, or evening. It is a honor for me to participate in this FATF webinar on financial inclusion with the distinguished moderators, speakers, and members of the Secretariat. So I will talk about now financial inclusion and MLA CFT supervision. Next slide, please. Okay. So like a contextual factor, it's important to say that Mexico is a country where the financial system serves almost 5,000 regulated entities, including banks, fintechs, and other intermediaries, such as money transmitters, which means that said number is a supervisory universe of the supervision of the National Banking and Securities Commission of Mexico. One of the court's mandates at the CNBV is clear: protect the financial system while enabling safe and inclusive financial integrity, as term used by AFI, through a truly risk-based approach. So financial inclusion for us is not a secondary objective. It is a fundamental pillar of an effective MLA CFT system. It's a win-win, as FATF Madam President Elisa de Anda has said many times. The more people use formal, supervised financial services, the less space there is for exploitation by criminal networks. So excessively MLA CFT rigid controls can produce unintended consequences like push vulnerable groups such as migrants, refugees, or low-income populations into informal channels, reducing transparency and control of possible illicit flows. So the FATF 2025 amendments to recommendations 1 and 10 recognize this reality, encouraging simplified due diligence where risks are demonstrably low. Mexico is fully aligned with this evolution. Next slide, please. So Mexico has built a multi-layered policy architecture that encourages financial inclusion through MLA CFT measures. These measures have considered the next national regulations. First of all, our national financial inclusion policy, which is updated every 6 years, guiding national strategies holistically. Secondly, the national risk assessment, that by now is 2023, that identifies specific risk factors related to financial inclusion, such as migration routes and cash-intensive zones. Secondly, we have the sectorial financial laws, which set the baseline MLA CFT obligations across the financial system. And in the fourth part, we have the general MLA CFT provisions that adopt a tier KYC DDC identification system that enables low-risk customers to access financial services under simplified requirements. So these architectures makes proportionality not an exception, but a structural feature of supervisory model. Next slide, please. So as a support for supervised entities and looking at operationalize the FATF visions, Mexican supervisors develop a comprehensive guide for simplified identification measures, considering the tiering level accounts, applicable for some supervised entities, such as fintechs and MBTS, who are considering in Mexico as promoters of financial inclusion. This guidance provides supervisory expectations for applying tier KYC based on risk levels and transaction limits. Also ensures institutions embed simplified measures with their internal risk-based methodology, not a standalone checklist. So it encourages innovation under clear guardrails, allowing fintechs and other institutions to expand access safely. These guides reflect FATF amendments and show how proportionality can be implemented without weakening MLA CFT safeguards. Next slide, please. So we have a success story that we want to show to you. And first of all, one of Mexico's clearest examples of the promotion of financial inclusion through simplified due diligence measures is CompraPago, who is a fast-growing fintech supervised by CNBP. The institution applies levels 1, 2, and 3 of identification exactly as the general provisions require, demonstrating that simplified measures can scale responsibly. CNBP conducts remote inspections, thematic reviews, and guidance letters to verify correct application of the tier KYC. In less than 2 years, it reached 12.5 million clients, many of them first-time users of formal financial services, considering that Mexico has almost 130 million inhabitants. It means that CompraPago is providing financial services to 9.5% of Mexican population. So this case shows that growth, innovation, and MLA CFT compliance are not conflicting goals when the risk-based approach is applied consistently. Next slide, please. So Mexico's approach is generating measurable positive impact, such as millions of new clients, especially migrant, low-income individuals, and rural population, access for the formal sector safely. It reduces incentives for informal transactions and strengthening financial transparency. Also gives better institutional risk management and a culture of collaboration between supervisors and industry for encourage the use of simplified DDC measures. Also, data-driven supervision ensures that simplified measures are monitored, not misused. So our philosophy is simple. Build bridges, not barriers. Next slide, please. Thank you. So we have some ongoing challenges and the final closing remarks. So some challenges remain, ensuring institutions maintain robust monitoring of simplified accounts. Also, strengthening data quality from fintechs and emerging entities, and increasing supervisory capacity to oversee rapid digital onboarding models. So these are global challenges, and international cooperation through sharing experiences, especially within FATF Global Network, continues to be essential. So financial inclusion and MLA CFT are not competing agendas. They are mutually reinforcing. Mexico's experience shows that proportionate risk-based supervision expands access, protects integrity, and fosters innovation. And the 2025 FATF amendments offer a historic opportunity for all countries to advance in financial inclusion objectives without compromising the security and integrity of the financial system. Thank you.
Thank you for sharing with us Mexico's experience in supporting risk-based approach in AML CFT with national policies and guidance from supervisors. Now, after hearing public speakers from public sector, now let us hear from private sector experts as well. Helen, your institution, the Dutch Banking Association, has a long experience in focusing on both higher and lower risk scenarios. How can guidance and toolkits from industry organizations help financial institutions put risk-based approach into practice? How can supervisors and industry organizations discourage over-compliance and gold plating? Over to you, Helen.
Thank you very much, Takahita, and it's a pleasure to be here in this esteemed group of AML professionals. And also thanks for your questions, because they relate very much to the Dutch journey towards a risk-based proportionate approach, which contributes to the financial inclusion. And over the last years, we have undertaken multiple actions in the Netherlands to improve that risk-based implementation. And for this webinar, I would like to highlight 3 collaborative initiatives, which we have undertaken with banks, the supervisor, and other public partners. First one is the creation of risk-based and sector industry baselines, and we had the first publications of that in 2023. The second is the fin-crime threat assessment for banks that we did, including public partners in that, and we did that for the first time in 2024. And lastly, this year's study by the Dutch Central Bank on the application of the risk-based approach for specific client groups. And if we move to the next slide, I'll zoom in on those industry baselines. And maybe first remark is that what has been the key success factor for those industry baselines is the joint and open dialogue that we had with banks, supervisors, and the different sectors in the room. And we started that after the publication of DNB's report From Recovery to Balance. We organized roundtables with indeed banks, DNB sectors, and also our Ministry of Finance at the table to create industry baselines with clear principles for risk-based CDD. And for the various sectors that experience difficulties with access to financial services, we included in those baselines more detailed descriptions of risk reducing and risk increasing factors, increasing the predictability of what questions they would get and what information could be delivered for that. And in doing that, in these conversations and publishing these, we have aligned the risk-based approach for both the execution and in supervision. Some of the examples, some of the publications we did are on client data, on ongoing due diligence, also on PEPs, and most recently on cash. Examples of sectors for which we published an industry baseline are not-for-profit organizations. That was our first one. The last one we did was on the automotive sector. And I think in general, what these entail is that it demonstrates that risk-based is more when necessary and less where possible. And that same motto, and if we move to the second slide, I'll move to the second topic, because that same motto, we have applied that in a different setting, and that is the financial crime threat assessment, which is also aimed at achieving targeted risk-based controls based on actual risks. And in the Netherlands, we regard collaboration and partnerships as essential to achieve that. And within our ecosystem for anti-money laundering and countering terrorist financing, various parties have many insights and a lot of expertise is available. And that's why in 2023, we took up a project with both public and private partners, which resulted in that joint FinCrime threat assessment for the Netherlands. It also included a for banks edition, which also includes what banks can identify and what we can detect, making it a document which is way more specific and more detailed than our national risk assessment. I'm not going through all what you see on this slide, but the key element is that you see the financial crime threat assessment at the center of this because it drives our priorities and our activities. Since the current world is quite dynamic and our insights develop as well, we are doing a new edition, which we started earlier last month. And if we move to this next slides, I will elaborate a bit on two important additional elements that we have added for this edition. We are still bringing together many experts from that ecosystem. So that includes 5 banks, AML and data privacy supervisors, FIU, several law enforcement authorities, public prosecution, and our Ministry of Finance and our Ministry of Justice and Security are also on board as observers. What we're doing this time is using a more data-driven approach to identify both low value and high risk focus areas. So both low value and high risk, creating a balanced threat assessment. In the final stage of this one, after having deep dives and doing a full review of that threat landscape, we will also involve prioritization, which we will be doing with that whole system in the room. And in that prioritization, again, not just focusing on high risks, but also determining indications of low risk. And the result of that FinCrime threat assessment, banks can use those insights to focus their controls in a data-driven manner, following that risk-based prioritization. And again, that supports in doing more where necessary and less where possible. If we move to the next slides, because I've elaborated now on the industry baselines and the FinCrime threat assessment for banks. The third topic, not supplying a more detailed slide on that, but it's an important exploratory study that DNB, the Dutch Central Bank, did today amongst Dutch banks to see how our AML measures are adapted for specific client groups. Less detail, but because the publication of that report is only later this month, but I would already like to share our banking perspective on this valuable study. Its aim is to assess how banks differentiate their controls and their measures, and for that, 4 different specific client groups were included in that study. And yes, we see that banks experience factors and difficulties that sometimes can prevent proportional application of those controls and measures, though no structural unnecessary impact for clients has been observed. The client groups in the study are mostly classified as low risk, but we do see differences amongst banks, and sometimes we see less differentiation across those risk classifications. We've also seen factors that influence that proportionate application, and by identifying that, we have seen new possibilities for further improvement. You can think of the dynamics of feedback, the effects that we see of the published risk indicators, and also the value of dedicated knowledge and skills for certain specific client types. Again, this shows that it's key to combine a risk-based execution with risk-based supervision. And I do believe if I see the changes in the amended FATF recommendation 1, that it is there present as well. Hopefully this gives you an insight on the journey we're on, and yes, more to come, and good to keep on jointly working on this in a collaborative manner with an open dialogue. Back to you, Takahide.
Thank you, Helen. Indeed, offering examples of proportionate measures and facilitating shared risk understandings are very useful in encouraging adoption of risk-based approach to AML CFT. Thanks to the presentation from our esteemed speakers, we now have deeper understanding on financial inclusion and financial integrity as mutually supportive policy objectives, as well as recent revision to FATF standard and methodology, and their implications on financial inclusions. We have also heard the experience from different countries in implementing a risk-based approach to AML CFT with a view to promoting financial inclusion. Let's now focus on main challenges faced by supervisors and regulated entities in promoting financial inclusion through a risk-based approach, and on what additional support is necessary. Now, before we continue the next discussion, I'd like to ask FATF Secretariat to highlight our survey result. FATF Secretariat, please.
Thank you, Takahide. Prior to the webinar, the participants have been invited to participate in a survey through the registration link on their experience in identifying lower risk scenarios, as well as applying simplified measures or exemptions. Also, the barriers that they found in implementing a risk-based measure. We've received around 200 responses, and approximately 150 of them are from private sector. So these results provide very valuable insights, but at the same time, we are also mindful of that the sample size, as well as the geographical and sectoral diversity of the survey is limited. And the insights, while very useful, they may not represent may not be fully representative of all stakeholders or all perspectives. So from the results that we've received, yes, around 70% of the private sector respondents indicated that they have identified areas of lower risk or low risk in their recent risk assessments. And at the same time, almost 60% of them indicated they have applied simplified measures, but around one third of the respondents indicated that they did not apply any any simplified measures or exemptions. So we can see that there's a minor gap in identifying lower risk scenarios and at the same time and applying simplified measures in those scenarios. So what are the challenges that the respondents are seeing in implementing a risk-based approach? The top 3 barriers highlighted by the respondents are include limited resources to differentiate the measures, as well as a fear of penalty from supervisors and the lack of clear guidance to do so. So what would be the most useful for them in supporting their implementation of the risk-based approach? So from the survey, respondents indicated that further guidance from FATF to clarify the roles, as well as guidance and examples and practical examples on exemptions would be useful. And other 2 areas that are considered useful are technological solutions, as well as further guidance from the supervisors specifically on identifying those lower risk scenarios. So we would like to thank all the participants who have participated in the survey and which offered very useful results that could enrich our further discussion on this webinar. And with that, I'll pass the time back to Takahide and the speakers to continue the discussion. Thank you.
Thank you, Jenny, for the introduction of the result of the survey. So now the Secretariat introduced top 3 barriers identified by respondents: limited resources, fear of penalty, and lack of clear guidance. So I'd like to continue the discussion on this barrier of implementing proportionate AML CFT measures, including simplified measures, when the risk is lower. Lobbying. Now, what are the challenges reflected by AFI's members? Any particular challenges facing less developed countries? Any insight on the barriers we face in implementing proportionate measures? Thank you.
Yeah, thank you, Takehide, for the question. So, of course, the challenges do vary across jurisdictions, as the survey also showed. But there are three I'd like to highlight that do come up repeatedly across our membership. So the first, I think, is capacity and data gaps, especially in relation to risk assessment. And of course, effective implementation of risk-based approach really needs to have that foundation of robust and high quality risk assessment at the heart of it. So if regulators don't have good data on where the real risks lie, then it's going to be hard to justify simplified measures for some consumer segments. So building capacity for robust and inclusive risk assessments is an ongoing challenge. The second one I'll highlight is a long-standing concern, I think, about how FATF mutual evaluation assessors will view simplified measures. And this can sometimes lead to overly conservative approaches to overcompliance. So in that sense, the changes now to the assessment methodology and the recognition of financial exclusion in particular as a risk to be assessed could be quite critical. And it will be very interesting to see the first mutual evaluation reports coming out in the new round to see if we do have assessors really being able to challenge whether countries have done enough to address financial exclusion risks. And then the third challenge, I think, is institutional silos and communication challenges. So in some jurisdictions, we find that the national risk assessments are not always effectively communicated to the private sector or sometimes even across the public sector. And if the financial institutions don't know the public sector's assessment of risks, then it will be very difficult for them to confidently apply the risk-based approach themselves. So I think communication between public and private sectors, especially in information sharing there, is an important area to strengthen. So those are three that really stand out for me.
Thank you, Robin, for your insight. And one of the 3 points you raised what is how the simplified measures are assessed under the FATF's mutual evaluation. So I think the existence of that issue is now, I think, on the high radar of FATF, and we will make sure that this recommendation change will be accurately and adequately assessed and in the mutual evaluation. And thank you very much for raising that important issue. Now, I'd like to come to Helen on the same questions. Any further observation from industry point of view in terms of the barriers of implementation of proportionate measures, especially the simplified measures when the risk is lower? Helen, the floor is yours.
Yes, and I think we've covered some of these things and recognized that in that survey as well. So adequate risk-based supervision, guidance, and also common risk understanding. And one I might want to highlight is that if we have the objective of achieving effective outcomes, it's essential to achieve that targeted risk-based controls on actual risks, and the feedback loop with insights and outcomes from intelligence-led collaboration and partnership that feeds directly into the risk-based controls of banks, making that more targeted and thus more proportionate. That way we improve effectiveness of that ecosystem, but make it also more efficient and reducing unnecessary friction for clients in stopping what is low value and not contributing to those effective outcomes. And as a banking association, we have an active role in initiating and orchestrating and driving what we call our next gen strategy, where we intensify that collaboration and use the joint intelligence-led investigations and work that we do to improve those risk-based controls. And yes, looking ahead with the AMLR coming up, based on Article 75 in the AMLR, we can further strengthen what and how we can share with public and private partners, and we can operationalize that into a robust process. So yes, we are on a journey, but that should be aimed at while we comply with laws and regulations, we also need to dare to share as much as we can, while keeping our clients safe.
Thank you very much, Helen, for your very insightful comment. Yeah, I think, yeah, as you said, the collaboration between public and private, as well as information sharing, and also the feedback loops, something we've heard very often on this topic. And I believe those things are not only useful for this objective of promoting financial inclusion, but also very important to enhance the effectiveness of AML CFT regime. And thank you very much for that. And now we've covered the barriers we are facing in a correct implementation of this revised standard. But I'm aware that throughout the survey, many respondents say that the guidance from FATF and also from supervisors should be very helpful to promote the effective and also the accurate implementation of this revised standard. With that in mind, I'd like to ask a question for Flora. And can you share with us Mexico's experience in providing guidance on risk assessment methodology by financial institutions? Flora?
Yeah. Thank you, Takahide. I hope you could hear me well now. So it's very important, this question, because the first thing that a country needs to build is the capacity building on the supervisors, because the supervisor will be the specialist that will analyze. It's like the AFI said, it's that, like Robin said many times, right? We need to make this capacity building. So in the CMBB of Mexico, we have this specialist related with the risk-based approach analysis of the methodology. This is a very important point. The other part is that we are trying and we are applying and we are implementing these public partner, private working groups with the private sector in order to make a common understanding of the risk-based approach. So it's very important, that part, because it's not just about to having a tiering approach like level accounts like we have in Mexico, but it's also important that the private sector have this common understanding with the supervisors. And the other part is also that every time that we have the opportunity to go on an on-site visit, one of the things that we analyze is the risk-based approach methodology and matrices of the financial institutions. With this in mind, we set up building. We build a set of recommendations for them, and we try to concrete and we try to build with them this methodology and matrices in order to promote financial inclusion through simplified due diligence measures. And finally, it's important that the financial institutions be aware about the transaction in these lower accounts, in these lower risk accounts, because they need to implement some kind of systems that has the capability of trace perfectly this for avoid the misuse of these accounts. So that part would be very important for us. Thank you, Takahide.
Thank you, Flora, for your insight. And I'd like to thank you again to our speakers for sharing with us your view on barriers and support which are necessary for implementation of risk-based approach to AML CFT. On top of what we have learned from speakers so far, we have also received over 1,000 questions from participants through the registration or email. But given the limited time we have left, of course, it will not be possible for us to cover all these specific questions. Therefore, we have grouped the questions by topic and identified the most common ones for discussion with our speaker today. So I'd like to start on the topic of use of new technology and technical solution. Catherine, a large number of questions concern the use of new technologies. Indeed, the technological solution was also highlighted by the survey respondent as one of the most useful support to implementing a risk-based approach. On this, Catherine, you mentioned during the presentation that standard revision this time also addressed non-face-to-face interactions, which has become a normal business practice nowadays. Can you share with us more on this revision and practical example of appropriate mitigation measures, please? Catherine, I think you are muted. It seems you are still muted now. Okay, it seems, Catherine is still muted. So I'll come back to you on this question later. And I would like to ask questions to other panelists, other speakers first. So I'd like to come to Robin now. In view of the revisions of FATF standards this time, can you share with us experience from AFI members in utilizing digital identity systems and eKYC to promote access to and usage of financial services? Robin, please.
Yes, thank you. So new technologies like digital identity systems and the electronic KYC regulations that have been rolled out to accompany them, they definitely hold a lot of potential for inclusive integrity. They can significantly lower the cost, of course, of onboarding customers. They can also reduce a lot of the frictions associated with paper-based account opening. Of course, these systems do need to have appropriate levels of robustness, but there is quite a lot of guidance out there now on how to achieve that, both the FATF's 2020 digital ID guidance. In AFI, we also have a digital ID and eKYC policy model published a couple of years back as well. So this is no doubt a trend that is present. It accelerated during COVID, and it's continued to accelerate afterwards with digital onboarding really becoming the norm. And we're seeing as well lots of real world success stories here. In Southeast Asia, Malaysia and Thailand are very good examples that have introduced eKYC guidelines, allowing to use the National Digital ID database and biometrics to open accounts remotely. And of course, India was a very famous example with its Aadhaar digital ID and eKYC platform that actually allow for 300 million previously unbanked customers to come into the system for the first time. So there's a lot of guidance in this area, a lot of good country practice as well to build on. I think the challenge is just to try to accelerate the rollout globally, including to lower capacity jurisdictions.
Okay, thank you very much for very useful insight and your comment. Thank you very much for that. Now, let us come back to Catherine to address the earlier question. Catherine? Yes, I think it seems you are still muted. Could you try it again? So I think it seems you are muted. So I will deal with questions to other panelists and come back to you later.
Is this
Oh,
okay
please.
now?
Yeah, now I could hear you. Please continue.
Okay, I'm sorry, it was wrong with the settings. Well, thank you for the question. Well, it's true that the advancement and the increasing use of technological innovation has the potential to improve financial inclusion, and many banks have developed systems tracking sometimes behavioral monitoring, such as digital habits, the IP address, Wi-Fi network, or device usage. And this data is used to create a profile and detect anomalies in user behavior. And artificial intelligence also should be noted, and as well as machine learning models, which can be used to assess transaction risk based on factors like transaction value, time, and consumer characteristics. In the guidance, you may read a lot of interesting cases. There is, for example, a case study on a bank in Brazil, but many other very interesting case studies that are to be read in the guidance. Just a few words. Thank you.
Okay, thank you very much for your comment. Now we covered new technologies and also the technological solutions. And in my understanding, among a lot of questions we've received from audience today, many of them are about simplified measures. So I'd like to ask questions to Helen and then Flora before coming back to all the speakers for their concluding remarks. First, Helen, and we have heard much about simplified measures through application of technologies. And of course, related question many participants would have is when would such measures be applicable? And how can financial institutions demonstrate effective and proportionate AML CFT controls? Over to you, Helen.
Yes, thank you very much. And do believe that technology will help us ahead in achieving that, whether it's on a risk detection or on assessing it, but for sure spending our time and efforts in the right places. And doing that, yes, obviously we need to comply, but the value is in the information that we offer to public institutions in the reportings that we do. To do that in a risk-based manner, and yes, I've had that question quite often as well, how do we demonstrate that it's effective and proportionate? And I think many parties are still working on that, but maybe I can offer some thoughts on that. Because if it's truly risk-based, it needs to be proportionate, it needs to be prioritized, and it needs to be effective. On the proportionality, one of the things we're looking at and evaluating is how do we do our client outreach? How often do we do that and for what purposes? And just thinking of the technological solutions that were just mentioned, all outreach that we might do just to gather data, there are more technological advanced digital identities to provide for that. I think that will be a relief in the proportionality of the customer effort that is required. So customer effort, a good one to monitor there. The other one on prioritization, which is essential to achieve that, it's good, and we have to look at what prioritization do we do in threats, but then let's also evaluate and assess how our coverage is of prioritized threats. That's where we want to see where the capacity and the efforts of obliged entities is invested. And yes, be okay and have comfort that we do indeed less where we see low value in that. So coverage of prioritized threats. And then on effectiveness, it's the outcomes that count. And for that, we do need the effectiveness to see that throughout the ecosystem, what do we actually get? And again, use that to prevent. And that's where effectiveness comes from. This is not an easy task to monitor and measure this. And it's not up to one party, but we do need that information in that full value chain. So work to be done there if I look around me, both national and internationally.
Thank you very much for your very insightful comment. Now we understand a bit more about the perspective of private sector. I'd like to listen from supervisors as well. And Flora, how do supervisors ensure financial institutions dare to implement simplified measures when the risk is lower? How can supervisors assess the appropriateness and effectiveness of risk-based measures? Flora?
Thank you, Takahide. Okay, first of all, it's important to say that in Mexico, we have one prohibition related with use simplified measures in the presence of higher risk. This is very important because we have this by dispositions. The secondly, like I said before, it's important to understand the capacities and the risk-based approach performed by the financial institution that you are supervising, because it's not the same for a bank, it's not the same for a fintech, and it's not the same for an intermediary. So understand the model of operation and the capabilities of the institution is very important also. Then you need to, with this perspective, the supervisors need to analyze. But first of all, it's important to say that risk-based approach methodologies and matrices is one of the most complex parts for the supervisors to analyze, because it requires to understand perfectly not just the operational model, but also the risk of a country. So it's very important to be aware of all the risk that the national risk assessments provides and other information also. Once you have that, the supervisors, first of all, needs to have these recommended actions for the institutions. More than put a sanction, it's better to have recommended actions in the first place, right? So when you provide these recommended actions, and then you have the capability to know that the financial institution performed that recommended action, maybe it's not necessary to have these sanctions, because we are trying to encourage the lower risk accounts. So having said that, I think that is the most important part of this, to encourage for part of the supervision, but also to have this accompanied with financial institutions for implement those measures. Thank you, Takahide.
Thank you for your additional insight. Now we are almost running out of time. So before we close, I'd like to ask each speakers to share your closing remarks within 1 minute, starting with Catherine. Catherine, floor is.
Yes, thank you, Takahide. The lesson I think we can learn is that financial inclusion and AML CFTs are not opposing goals. They are complementary pillars of a safe and resilient financial system. While expanding access to financial services must go hand in hand with safeguarding integrity, transparency, and trust. And it goes for everybody, every actors, supervisors, regulated entities, everybody is in the same boat to go to this goal. This is also the new phase for the risk-based approach. Thank you.
Thank you. Robin, please.
Thank you. I'll close by saying that the vision of inclusive financial integrity that I started with, it's absolutely possible. And I think the FATF initiatives under the current presidency have given a tremendous amount of momentum and maybe even a game changer towards achieving this vision. But at the same time, it's really important that we guard against complacency, because what happens in the next chapter with implementation is going to be even more important. So I'd just like to maybe give everyone on this webinar a little bit of homework to think about what role your own organization can play to make this vision a reality. Thank you so much.
Thank you. Flora?
Well, I just want to have these remarks. Like Afi said, no, it's important to protect the financial integrity. How one of the measures that we could take to take this financial integrity to protect is to promote and encourage the use of simplified measures, because the more people are in formal channels, no, so the less opportunity to the criminals to exploit the operation of these people. So thank you so much.
Thank you. Helen?
Yes, good to be looking ahead as well. I think there's further change to embrace. And I think I have a couple of C's to add to that. It will take courage to do that. We need clarity amongst the parties so that we can achieve consistency and strive for common priorities. And to do that, we need collaboration. So courage, consistency, clarity, common priorities, and collaboration. And I think we can truly together embrace that change.
Thank you very much. So to wrap up, as mentioned previously, risk-based approach and proportionality is a very key concept in the FATF standard. And also those kind of FATF message was clarified by the revision of Recommendation 1 and other recommendation, as well as FATF guidance that were published in June. And it is very important to ensure that simplified measures are actually implemented on the ground when the risk is lower. So to do that, I think the capacity building and sharing of good practices, both by public and private sectors, and many other things that are mentioned in this webinar is very important. And also, to do a risk-based approach, to implement risk-based approach correctly, it's very important to ensure a common and accurate risk understanding between public and private sector. It's easier said than done. And I'd like to highlight the importance of working together. As mentioned, each of us has an important role to play to achieve an important objective of AML CFT and financial inclusion. Those parties include FATF, FIU, supervisors, private sectors, and other stakeholders. So I hope you found today's webinars is helpful to achieve our common goals. In closing, I'd like to thank speakers, interpreters, part of Secretariat, especially Francesco and Jenny, and all the participants. Thank you very much.